Auto insurance. It's that mandatory, non-negotiable legal hurdle that exists in pretty much every state across the U.S.
Right, you just can't drive legally without it.
And that necessity creates a massive pain point if you're new to the system.
A huge one. I mean, think about anyone who is establishing a life here. Maybe they're an undocumented immigrant, a new permanent resident, or even a foreign professional on a temporary visa.
Just getting this required product is, well, it's difficult and maybe most painfully, it's drastically expensive.
It really is.
Okay, so let's unpack this. We're deep diving into the systemic barriers facing millions of drivers who, despite being safe, lack the specific U.S. records that insurance carriers demand.
Our mission today is really to investigate three interconnected challenges. First, we have to look at the foundational policy. How does your legal status impact your ability to get a license in the first place?
Right, step one.
And then second, we'll look at why years of clean international driving history often just, evaporates the moment you cross the U.S. border.
And crucially, for our third point, we're going to connect these newcomer issues to the much broader national problem, the one that penalizes all drivers, even people born and raised here.
The heavy hand of the credit score.
Exactly.
Oh.
So let's start at that foundational requirement. To get insured in the U.S., you first have to have a valid driver's license.
Mm-hmm.
So if you're an undocumented immigrant, your ability to get auto insurance is completely tied to whether your state allows you to get that ID.
This is where state-level policy just makes all the difference. Currently, it's 15 states, plus Washington, D.C., that have laws allowing undocumented immigrants to get driver's licenses.
And these are some big states, right?
Oh, yeah. We're talking about places like California, New York, Illinois, New Jersey, Maryland. Areas with high population density.
So that's a significant policy lever. But beyond specific state laws, there's also the federal DACA program, which provides a different route.
DACA is a huge differentiator. So individuals who qualify, and this means they were under 31 as of June 2012, arrived before they were 16 and meet other requirements.
Right.
They're eligible to get a Social Security number and employment authorization. This means DACA recipients can get licenses in every state.
Wow, every single state. That simplifies things immensely.
It does. It opens up access to the entire financial system, not just driving.
New York's experience really highlights the immediate impact here. In 2019, they passed what was called the Green Light Law.
And that allowed over 250,000 undocumented New Yorkers to get licenses. But the really critical part, and what our source material emphasized, is that the law also explicitly required insurers not to discriminate based on citizenship or legal status.
That anti-discrimination clause seems vital.
Oh, it's everything. Because getting the license is the first step, sure, but it doesn't solve the second, arguably bigger problem, the cost.
So even with a license, you're still seen as an enigma.
Exactly. And that enigma, that uncertainty, it translates directly into high risk and very, very high premiums.
Okay, here's where it gets really interesting. You've followed all the steps, you've secured your license, and now you have to buy insurance. Why are the rates still so punishingly high?
It all boils down to one single concept: the lack of a known, verifiable U.S. driving record.
So it's not about your actual driving skill, it's about the data they have on you.
Precisely. Insurance carriers rely on data they can confidently vet. And if they can't see 3 to 5 years of clean driving history in their system, they price that uncertainty aggressively.
I think we saw a quote from an immigration lawyer about this.
We did. They said if a person hasn't held a U.S. license for at least 3 years, their history is less known, and the company prices for that potential risk.
That uncertainty tax has to be painful, even for people with decades of clean history somewhere else.
It's brutal. We saw the case of Hamid Yousafzai. He moved from Afghanistan to Canada and faced the same exact challenge.
He had a long driving history, right?
7 years of established driving experience in Afghanistan. But when he went to buy his first car in Canada, he was quoted an initial premium of $450 a month.
$450 a month.
A month. All because the Canadian companies just refused to factor in his foreign driving history.
That is the definition of a crippling cost. He eventually had to take a huge risk just to afford to drive.
He did. He downgraded his coverage to one-way insurance.
Which means
it only covers the other car in a collision, not his own vehicle, not his own injuries. That dropped the cost to $200 a month, but he called the whole experience an injustice.
You can see why. And this underlines the core issue.
Yeah.
The insurance requirement can become this final insurmountable barrier.
It's so ironic because buying the vehicle itself is often technically achievable. If you have a valid license, proof of residency, pay stubs,
You can get the car.
you can get the car. But if the mandated insurance is unaffordable, the car just sits there, an expensive paperweight.
So let's focus on that foreign history paradox. For someone who is an established international driver, why is the standard U.S. practice so strict? I think Liberty Mutual's policy was pretty clear on this.
Yes, their general rule is that foreign driving history does not transfer, period. You are treated as a brand new driver.
And what's the official rationale there?
Well, if you ask the carriers, they'll point to things like administrative burden, the difficulty of verifying records from dozens of different countries, and just a lack of standardized data.
So they argue it introduces too much risk.
Too much risk into their underwriting models, yes.
But internationally, this isn't always the case. We found some companies that have actually figured this out.
That's right. Take the UK market. We found an insurer called Marshmallow that specializes in covering UK newcomers, and they do accept foreign history.
How do you do it?
They look for what's called a no-claims discount, or NCD. It's basically your claim-free driving bonus. And to prove it, drivers need specific documents, a closing statement, an official letter from their old carrier, things like that.
So it's complex, but it is absolutely possible if the will is there.
It's possible. Even Canada has mechanisms. In Manitoba, you can get a discount, but you need both a claims experience letter and a driver abstract on letterhead. It's a heavy bureaucratic lift, but it exists.
And the hurdle gets even higher when you look at true non-residents, like visitors or temporary workers.
Right, like that example we found of the Australians who are buying a classic Austin Healey in Texas.
Ah, yes, the dream road trip. Sounds idyllic until you hit the insurance wall.
Precisely. They ran into an immediate brick wall because standard insurers required proof of residence and a U.S. driver's license, or SSN.
Without those, they're just...
Instantly categorized as high-H risk, and they couldn't even use their international driver's permits to help.
Because an IDP is just a translation,
Right.
not a real license.
It's just a translation, not a substitute. So it's almost absurd. They're buying this slow, low-risk classic car, but they're financially categorized as a major threat purely because of paperwork.
The risk assessment is purely logistical, not based on their likely driving behavior.
Exactly. It forced them into this specialized, much more expensive, non-standard insurance market. They needed specialty brokers, had to get a U.S. phone number, a garaging address. It just confirms that the biggest barrier isn't eligibility. It's financial and administrative gatekeeping.
So what does this all mean? We've seen that new drivers face these severe price penalties because insurers lack driving data they trust. But that penalty is compounded by a systemic issue that impacts all drivers nationwide, and that's the credit score penalty.
The credit score is the hidden financial anchor for millions of safe American drivers. I mean, the difficulty of proving foreign driving history almost pales in comparison to the sheer scale of how credit scores dictate premiums for people who have lived here their entire lives.
And the data from the Consumer Federation of America, the CFA, it's just stunning.
It is. We know that 47 states and D.C. allow the use of credit information in auto insurance pricing.
So only California, Hawaii, and Massachusetts have banned it.
Yeah. That's it. So let's look at the national averages for safe drivers. Clean records, driving a basic car with state minimum coverage. A driver with excellent credit paid an average of $470 a year.
Okay, that's the baseline.
Now, same driver, same car, same clean record. But they have fair credit. Their premium jumps to $701.
That's a 49% increase, just for having less than perfect credit, even with a spotless driving record.
And it gets worse. If that same safe driver had poor credit, their average premium skyrocketed to $1,012 annually.
Wow. That is a staggering 115% higher than the excellent credit customer.
A penalty simply for being financially vulnerable.
And that's not even consistent across the industry, is it?
No, it varies wildly. State Farm showed an extreme surcharge. They charge poor credit customers 224% more than their excellent credit customers. And geographically, it can be even more dramatic. Michigan showed the most severe penalty, a 263% average increase for a safe driver with poor credit.
This moves the conversation firmly away from risk based on driving and into risk based on finance. So let's put this in the starkest context possible. How does having poor credit compare to, an actual dangerous driving infraction?
The comparison is, well, it's truly difficult to reconcile with the supposed purpose of auto insurance.
Go on.
The CFA data reveals that in most states, having poor credit poses a higher financial penalty than having a drunk driving a DWI conviction.
Wait, say that again. A safe driver is penalized financially more heavily for being poor than a documented drunk driver is for endangering people on the road.
On average, yes. Across the states that allow credit scoring, safe drivers with poor credit paid $600 more per year than excellent credit drivers who had a DWI conviction on their record.
It raises a profound question about what the system is actually designed to penalize.
It does. And it also deeply entrenches structural inequality. We know that credit scores correlate heavily with income and race.
Right, the Urban Institute data on this was very clear.
Absolutely. Median credit scores for white communities sit around 727. For Hispanic communities, it's 667, and for Black communities, it's 627.
And for lower-income families, it's just harder to even establish credit in the first place.
Exactly. They're more likely to be among the 26 million Americans who are credit invisible, or they only build credit based on negative records like collections or missed payments. So using credit as a proxy for risk ensures that people who are already struggling are charged more for a legally mandated product.
Which further limits their economic mobility.
And that's why we see political pushback. Legislation like Colorado's SB 21-169, which requires testing for unfair discrimination. It's also why some newer insurers and even established ones like Allstate are looking seriously at moving toward telematics, tracking driving behavior directly instead of relying on this opaque financial data.
So we've really uncovered a dual challenge here. New drivers face these uncertainty penalties based on where they drove before.
And all drivers in most states face these severe penalties based on where they bank now.
Both are non-driving factors dictating the price of a product you are required by law to have.
Precisely. And if we accept that auto insurance is legally required to drive, we have to ask ourselves a pretty fundamental question. Should the price be based on a driver's verifiable behavior on the road? Or is a driver's financial history always a valid predictor of their insurance risk? It's a debate that affects safety, mobility, and fairness for every single person who gets behind the wheel.